Price-earnings ratio metric valuation. A relative valuation using the PE ratio means comparing a company's price-to-earning ratio to the average PE ratio of similar companies within its industry, allowing investors to gauge whether a stock is considered cheap or expensive relative to its peers. For example, if a company has a PE of 15 while the industry average is 20, it might be considered undervalued based on this metric alone. Key points about relative PE valuation. Calculation. To calculate a company's PE ratio, divide its current stock price by its earnings per share. Interpretation. A high PE ratio indicates investors are willing to pay a higher price for each dollar of earnings, potentially signifying high growth expectations, while a low PE might suggest a stock is undervalued. Industry comparison. The most important aspect of relative valuation is comparing a company's PE to the average PE of its industry peers. Example, Company A, stock price $50, earnings per share $2, PE ratio 25, calculated as $50 divided by $2. Industry average PE 20. Analysis. Since Company A's PE is higher than the industry average, it might be considered overvalued compared to its peers, suggesting that investors are paying a premium for its stock relative to other companies in the same sector. Important considerations. Growth potential. Companies with higher expected future growth often have higher PE ratios. Quality of earnings. A high PE might not always be a bad sign if a company has strong fundamentals and sustainable earnings growth. Market conditions. Overall market sentiment can also influence PE ratios.